So, inflation. But first, the intro. Hi, I'm Peter. Money. I worked for over 20 years in finance for some of the biggest companies in the world, and now my channel is devoted to helping people like you make better financial decisions in your own self-interest. Inflation hit 9.1% in June, the highest level in over 40 years. People are scared. What if it continues? What if we have hyperinflation like they did in Germany and Venezuela? Everything costs more. Eggs are up 12%, beef up 16%, airline tickets up 34.1%. The only thing that hasn't increased in price is the fabled Costco hot dog and soda, which remains still $1.50. But there's only so many hot dogs you can eat, although I can eat quite a few. In this video, we're going to discuss inflation, how we got here, what's likely to happen next, what you can do to manage your finances, and why we're unlikely to see anything like what happened in Germany in the 1920s or more recently Venezuela. So first, inflation 101. Inflation is when your dollar buys less in the next year. So right now, a dollar today buys roughly what 91 cents bought a year ago. This number is calculated by the Bureau of Labor Statistics, which keeps track of a basket of things people buy. It includes food, gas, rent, entertainment. All these things have been tracked for many, many years. Year-over-year numbers are the best. Seasonal adjustment can be pretty confusing. 9.1% is a reliable number. Yes, we had inflation this year. We had inflation for a lot of very good reasons, but principally the inflation driver is if the supply of goods does not meet the demand for goods, the price of those goods will increase. That's what drives inflation. Three main reasons why we had low supply this year and high demand. The first one is oil. Oil is something that goes into almost every good. It's an ingredient in food. It goes into clothing, it goes into almost all of our transportation. The price of oil is way up, and it's way up because there's been a period of time when we didn't invest as much in exploration and production of oil, and we've had a war recently in Ukraine, which has disrupted the supply of oil from Russia, one of the biggest producers, to Europe and the rest of the world. This is not likely to persist. The price of oil has been relatively flat over decades because we've been very good at finding substitutes and getting more oil out of the ground. If the price of oil is high, people are going to go out and drill for oil, invest in refining and transportation to make oil more available. Also, when the price is high, it's a strong incentive to use less of it, buy a more efficient car, buy a smaller car, look into substitutes like wind and solar. So that's a natural self-correcting process that's part of market capitalism, and it does work. It's the reason why I'm pretty confident that the price of oil will go down again as it has in the past. Similarly, the supply of goods is also out of whack right now. Demand is way up because people didn't consume much during the coronavirus shutdown. They were stuck at home for a year, and the government flooded the economy with cash, giving people extra money to spend. They didn't spend much for about 2 years. They were given a lot of money. Now they've got money and they want to spend. They want to spend more than ever. The demand for travel and goods is way up. That's why airline tickets are so expensive. But this won't last either. It won't last because, first of all, the stimulus programs that gave people money to spend are over. The money that's in their accounts will dwindle and it'll go back to a more normal amount. Again, restoring the supply and demand balance. And the pent-up demand situation that we're in will also not persist. We're going to normalize that too. Demand and extra dollars will come down, and over time, supply will increase. It's going to increase because it's been disrupted. That's the third point. Overall supply of goods is down. It's down because most of the goods used in the West come from China. And China, in the short run at least, has been pursuing a zero COVID strategy, which means they shut down whole cities and lock everyone up in their houses if there's COVID anywhere. This has been highly disruptive, but like with oil and gas and other things, there's ways to compensate. The first one is that businesses that used to supply solely from China are now seeking suppliers elsewhere. They're moving production to places like Vietnam and India. That's going to slowly but surely increase supply. In addition, China is becoming more adept at managing through the COVID epidemic. So over time, this should normalize too. And that's the big message, that oil, cash, and interest rates, China, all these things will normalize over time. The last thing I failed to mention is cash. Cash came out of stimulus programs and interest rates were very, very low for a while. That allowed people to borrow and get lots of cash almost for free. But we've seen the Federal Reserve raise interest rates to slow the economy down and make things like borrowing harder to come by. This means that there's going to be less money available to fuel that demand, and again, it's going to help normalize the supply of goods and demand. So all that's going to happen over time. We don't know what's going to happen to inflation this month, next month, the month after, but over a reasonable period of time, it's very likely to come down into the target range. The target range is that level where inflation is actually good for the economy. A little bit of inflation gets people off the couch and into the stores. They say, I've got to act now, I've got to buy now, or it'll cost a little more later. Imagine if things cost less later, then there'd be no reason to leave your home. You could just wait and things would get cheaper and cheaper. Disinflation's real bad. There's another indication as to why inflation's likely to return to around the 3% level over the next 10 years, and that's the bond market. Right now, the US government can borrow money from investors at 3%, a little less than 3%. The reason it's settled there, again, is supply and demand. Investors are demanding a real return on their money. They're saying, sure, I'll loan to you, 3% is the price. If inflation was expected to be higher than 3%, they would have to demand more. They'd be losing money by lending to the government. There's a lot of money at stake here. People have thought about it. Smarter people than me have thought about it way more than me, and that's the number they've come up with. And I think they're probably right. Just one more thing. I mentioned how scary inflation can be, how scary it was to be in a place like Germany between World War I and World War II. During that time, if you had any kind of cash at all, the value was completely wiped out. Germany exited World War I with tremendous obligations and debts and about 4 billion marks in circulation. They had to pay off their debt, and they printed 1.2 septillion marks. That's a 1.2 with 20 zeros behind it in terms of the number of marks they printed in order to try and address their debts. Well, when a government prints that much money, people need wheelbarrows of cash with denominations of like 50 million marks, 100 million marks, 200 million mark coins and notes to buy bread and eggs and milk. The United States Fed did increase the supply of money during the coronavirus epidemic, but they increased it by a factor of 2 or 3. Nothing like the million, billion, trillion-fold increases that we saw in Germany and also in places like Venezuela during hyperinflation. I don't think you have to worry about inflation long term. I don't think you have to worry about hyperinflation. And what should you do with this information? Well, you're going to hear from me over and over again. The answer is nothing. Short-term fluctuations in financial markets and in inflation aren't information that you can use actionably in a sound financial plan. A sound financial plan means paying down debt first, establishing an emergency fund, and then steadily investing a relatively small fraction of your income, 5-10%, into the US stock market if you're an American. You want to buy a broadly diversified index fund such as the S&P 500 that's very likely to get you a market rate return somewhere around 8 or 10%, in line with the 10.5% that the S&P 500 has returned to investors since it was launched in 1957. If you put away a few $100s a month and you start young, you're very likely to have a nest egg in the millions by the time you retire at 65. That's the magic of compounding. That's what you should focus on with your financial planning. And inflation, it's going to come and go. It's probably going to return to the nice, stable, low single digits levels we've seen since the 1980s because the Federal Reserve has acted remarkably well, flooding the economy when the economy was shut down with cash, and now taking it away when things are getting a little overheated. There's a joke they used to say, the Federal Reserve is like a guy at a party who's supposed to take away the punch bowl just when things get interesting. And that's exactly what they're doing. Things are going great now. Unemployment's very low. People are demanding lots of goods and services. And the Fed is tightening up on interest rates and saying, no, a little bit too much. And I'm very grateful for that. It gives me confidence, and it gives the bond market confidence as well to say inflation really will be low in the future. If they didn't do this, then there is the risk that we could have some years of inflation, and then inflation expectations could get embedded into people's thinking, whereby they would have to say, I need to make sure I get a raise on my contract. I won't accept a contract without a 5-10% raise every year. And if that happens, then everybody does it. Then everybody says inflation is going to go up 5-10% a year, so I'm going to have to act accordingly and price accordingly. And then you have that embedded inflation expectation problem where it's very hard to unwind. But it's not really that hard. It turns out The Fed can unwind it like they did. The great Paul Volcker, head of the Fed in 1982, he took interest rates up to over 20%. He shut down the economy and broke inflation, and he did it just the way they're doing it now. They don't have to do anything like what Volcker had to do because embedded expectations are nowhere near as high. But that's how it works. When people are expecting more, raise interest rates, slow things down, risk recession. It's true, there is a risk of recession. But again, what should you do about this? Nothing. Playing the short-term game and guessing whether inflation is going to be X or Y% in any given month is really a hard game to play. Stick to your plan, save, pay down debts, live responsibly. Remember, happiness doesn't come from money. It comes from friends, family, and fitness. If you consistently save and put that money into the US S&P 500, by the time you're ready to retire in your 50s, 60s, or 70s, you will have a very healthy nest egg to take care of you if you start early and save consistently. Thank you very much. Like and subscribe, baby!